Hello and welcome to today's class where I'm going to work through one of the questions from the 2019 VCAA accounting exam. This was question one that's related to inventory. So what I would suggest you do now is spend some time reading the question, pause the video, spend some time reading the question, and then I will talk about the important points that you should uncover during reading time or as you read and mentally plan for answering a question. Okay, so hopefully you picked up that this business is using the identified cost, inventory, cost assignment method. They mark up inventory by 50%, which will be important if we have to answer anything regarding sales and sales prices. Part A is asking us to record 3 transactions in our inventory card. Part B is asking us to describe transactions. So from the 3rd of March, so this one, and the 12th of March, this one. We are then asked to prepare the ledger entries relating to Memo 43, and then we need to describe the effects on the financial reports of Memo 43. Okay, so let's start with part A, recording these transactions. So the first one, we know the date is the 14th of March. The source document is check 355. And so check 355 is for a cash purchase. So this is going to be inventory coming in. So we have 3 units coming into the business, and these cost of $20 plus GST. So GST is not included in the inventory card, giving us a total value of this inventory purchase of $60, leaving us with, in our balance, we have $11.25, $275 of value, and we have 3 coming in at 20 with a value of $60. Next, on the 22nd of March, so this transaction here, so we can put the date in, 22nd of March, Memo 46, and the source document is Memo 46, and this time the owner has withdrawn 2 copies. So we know inventory is going out, so we could record in the out column that 2 units have left. What was the cost of these units? Well, the great thing about identified cost is often the question will tell you, and they are valued at $25. So we have 2 units at $25 leaving, total cost of $50, leaving us with 9 about $25 units. 9 times 25 is $225, and we still have these other 3 from our $20 batch valued at $60. Next we have on the 30th of March an inventory count. So we have Memo 47 being our source document for this transaction. Now the inventory count uncovered that we have 13 copies of the Racing Plus video game. So if we look at our inventory card, for the count we had 12, 9 plus 3 is 12. So we've made an inventory gain of 1. And what is the cost of that inventory gain item? Well, we know we have 3 copies that were purchased on the 14th, so we still have 3 of the $20 batch, so we picked up one of our $25 batch. So if we add one at 25, leaving us with 10 units at 25, total cost of $250. We still have 3 at $20, with $60 value. So as you can see, our total balance, 13 units, agrees to our inventory count of 13 units. So part A is now finished. Okay, so part B is asking us, the command term is asking us to describe the transactions. So if we have a look at this first one, we need to describe 3rd of March. So this transaction here, 3rd of March, we have ourselves a credit note and in our in column. So this means we have a sales return. So a customer has returned inventory to us, hence it's been recorded in our in column. But we need to describe the transaction, so we can't just say it's a sales return. I would say it's a sales return of 1, the quantity, and the item is the racing plus video game. So describe more detail needed than just stating what it is. So we've actually said it's a sales return, and we've said it was 1 racing plus video game. So quite a descriptive answer then there. Well done. The second part of this question, we are asked to describe the transaction on the 12th of March. So let's have a look at this one to start with. So firstly, it's a memo. And what we see here is that although we have the transaction recorded in our out column, no actual inventory has left because we had 11 units as our last balance, then we still have 11 units as our new balance. However, what has happened is the cost price has changed. So this is an inventory write-down. So we'll record this. This is an inventory write-down, or we'll describe it. I'd say of 11 units to NRV of 25 per unit. So again, we haven't just stated it's an inventory write-down, we've described it. So we've said it's an inventory write-down of 11 units to their NRV of $25 per unit. So there we go, we've described those 2 transactions in part B. Now we can move on to part C. So part C is asking us to label the ledger accounts and prepare the ledger entries to record memo 43. So again, the memo we just described above. So we know here that we have an inventory write-down. So name the ledger account, and the other side of that will be inventory. So in the ledger, the date of the transaction, we know that it is the 12th of March. 12th of March. The cross-reference under inventory write-down, which we are debiting for the expense, will be inventory. And how much have we written the inventory down by? Well, if you can have a look, we have 160 plus 66, which is 226. So we have 226 debit inventory write-down to record the expense, and on the other side, 12th of March, we have a credit to the inventory account, our cross-reference being inventory write-down of 226. Okay, so part D asks us to describe, again they're loving this command term in this question, the effects that memo 43, their favourite transaction, would have on the financial reports of Max Games. So this question worth 3 marks. The fact there are 3 financial reports means we'll need to mention each of them. So firstly, what's the effect on the income statement? The effect on the income statement would be an increase in inventory write-down expense and subsequent decrease in net profit of 226. So a few important things here. I would make sure that you are quantifying it. So we have mentioned the financial report, but also which elements of that financial report, inventory write-down and net profit would be affected. So that's the effect on our first financial report. In the balance sheet, so our second financial report, inventory and owner's equity being net profit within there, would both decrease by, again, our 226. So we've mentioned our accounting report, we've identified the elements and we have quantified it. And lastly, don't forget the easiest mark. There would be no effect on the cash flow statement. So there we have it, A to D of that question. Well done, full marks.